If you clicked on this video, you're probably just like me that is looking for ways to grow my money from where it is now to probably $1 million, like I am. So this video is going to help you draw a strategic way of getting started with investing. I'm assuming you're probably new to investing. You've had to be investing from different sources, from different people, and you are just looking for a way to make your money work for you. You've come to the right place, and let's get right to the video. The first thing you need to understand about investing is to define your why. Defining your why is just getting yourself to understand why you are investing. So for me, investing is just a means to gain freedom. When I say freedom, I'm talking about freedom of doing what I want to do, traveling to wherever I want to travel without the constraints of money. So for you, it'll probably be saving up for retirement. It will probably be a down payment for a house. It will probably be just looking for a way to grow your wealth because you have an influx of cash and you want to find a way to retain its value and grow it over time instead of just leaving it in a bank account. So you need to be able to define your why. You need to be able to spell out exactly what it is you're looking for when it comes to investing. The second thing you need to be able to look for and you need to be able to understand when it comes to investing is educate yourself on the different options of investment that we have. So we have stocks, we have mutual funds, we have index funds, we have ETFs, we have real estate. Put all of those things together, understand exactly what works for you and what you seem more interested in. So educate yourself, do your due diligence, study, look it up, go onto the internet, go on YouTube, run a search on index funds, run a search on mutual funds, run a search on stocks, on bonds, on treasury bills, on real estate. Run a quick search and then understand what you are getting yourself into. The third thing you need to understand is to be able to assess your own risk tolerance. So for someone as young as I am, going more high risk is appropriate for me because I'm young. I could try different things. I could dabble in different things. If you are older, you shouldn't go high risk when it comes to investing. You should look for something more stable and something more sure. So on the extreme side of things, on the riskier sides is stocks and shares, and on the safer side is index funds. So you pick what works for you, and then in between real estate, businesses, all of those things, find what works for you and understand your risk tolerance. The fourth thing you need to understand is to start with a small amount. I can't emphasize this enough. Start with something little, start with something small. Don't rush it. The ideal amount I tell people to start with is $100 because it's easier to play around with, it's easier to throw around and see how you feel about the different forms of investing and the ROI, which is the return on investment that you get on each of those investments. The fifth thing you need to discuss here and the fifth step you don't have to miss is to choose the right platform. So recently, digitalization and social media and the internet has made it easier for you to invest from the comfort of your homes by downloading apps like the Bamboo app, Robinhood. So many of those are available now that makes investing much more easier. So what you need to be able to do is to choose the right platform. I'm a forex trader, and so it's easier for me to use Exness because Exness is the broker that I use to trade forex, and so using it to buy ETFs and index funds is much easier for me. However, if you are a newbie, if you're someone that's getting started with investing, I advise you download either the Robinhood app or the Bamboo app. Recently I've heard of an app called Ladder. I am yet to test it out for myself and I'll give you guys a review. However, the two that I always recommend for beginner investors is to download the Bamboo app or the Robinhood app. It is easier to just buy stocks on there and all those things. The third thing you need to be able to do is to diversify your portfolio. So when it comes to diversifying your portfolio, you need to be able to make sure that some of your investments are spread in different baskets. Don't keep all your eggs in one basket. That is what I recommend. I recommend majority of your investments be in an index fund, and the rest should be spread across. There are much more volatile things like stocks and shares, like real estate, investing in a business, probably through a venture capital, or probably through a private equity. And so if you diversify your portfolio, it makes it easier for you not to risk everything when one of them goes crashing down. So for example, the real estate industry was doing very well in 2020, 2021, and now not so good. And why I telling you to invest most of your things in an index fund is because the index fund is like a pool. It's a basket of the 500 top companies in the United States. And what happens is the index fund, they keep adjusting, they keep monitoring, they keep rebalancing to make sure that the 500 top performing companies are at the top. So let's say if today Apple stops performing properly, Apple will be dropped off that basket and the next high performing thing will be brought on board. So you have a piece of all those 500 companies. You have a piece of Tesla, you have a piece of Nvidia, you have a piece of Microsoft, and so forth and so forth. All right, so that is why you need to balance and diversify your portfolio. The seventh thing you need to be able to do is to monitor and rebalance your portfolio. So as they are doing that for the index fund, you need to do that for yourself. You need to be able to make sure that you balance your portfolios frequently. Look at what works and what doesn't work. All right, so let's say 2021 2022 that real estate was doing very well, probably had 30% of your investment in there. Now as we are in 2024 that they are not doing so well, you probably want to reconsider balancing. You probably wouldn't put much more now into it as opposed to what you'd have done in 2020. All right, so look for what is working very well now and invest more into that, and then keep rebalancing. The last thing you need to do when it comes to understanding what investment is about is staying informed. News is very important. The shooting of Donald Trump would trigger a lot of things, so you need to be able to see what, especially if you are holding stocks and shares, you need to be able to look at it and understand what is going on. The recent global outage, you need to be able to see what your stocks and shares are doing on the stock market. So for example, Microsoft is being affected, all those things. So you need to be able to understand what exactly is going on and how it's affecting your investment. Now let's go right into 3 mistakes that people make when they're starting investing. And I'm a victim of this. I have made all these mistakes when I started investing. The first mistake is not doing enough research, and that is why I said earlier that you need to be able to educate yourself about all the investment options that you have out there. I didn't do my due diligence, but now that I know better, that is what I'm saying. This is a mistake you should avoid doing. Do your research, do your homework, understand the investment in and out, understand what it takes, the risk involved, how to invest, the best platform out there. Just go on YouTube, go on Google, run a quick search. It will take you less than 5 minutes to do that. Do your research. The second mistake here is chasing short-term gains. I have been a victim of this because I transitioned from trading forex into the investing space, and I wanted to get in and out. When it comes to investing, it is in for the long term. That is why index funds mostly will tell you they give you 7% annually. This should give you a glimpse of what you get over a period of a year. So don't chase short-term gains, focus on the long term. So the third and the final mistake here is ignoring the fees and expenses. So when it comes to index funds and mutual funds, the fees vary. All right, so mutual funds tend to have higher fees as opposed to an index fund. So low cost index funds would include the Vanguard, the VO, and the Fidelity. All right, so those are the 2 ones that have very low fees. mutual funds tend to have higher fees, so I'd advise you stay away from them and rather go with an index fund. Same with the ETFs. So don't ignore the fees. It's the same as hopping into a trade. The fees come in the form of spreads, the amount of money the broker will take for getting into a trade. So for Exness, they have tight spreads, and I know this is technical because it's coming from the trading space. However, know and understand the fees that comes with each investment that you make. And if you love this type of content, kindly subscribe to this channel, leave a like and share with your friends. If you have any questions, leave them in the comment section and I would reply to all your comments. See you on the next one.